The screens were already red when I woke up, not the normal kind of red, not the slow bleed traders convince themselves is healthy consolidation. I'm talking about violent, cascading red, liquidity vanishing in real time, spreads widening like cracks in ice. XRP had just been delisted from a major exchange, and the market didn't just react, it recoiled. I watched portfolios get wiped out in seconds. People who sold everything, their Bitcoin, their retirement funds, even took out loans, all in on XRP because they believed the worst was behind it. Then came the headline, Exchange suspends XRP trading, effective immediately. No countdown, no phased withdrawal, just a sudden halt. Price collapsed as if gravity had been switched back on. Stop losses triggered in waves, margin positions liquidated, social media exploded with anger, fear, accusations. But here's what bothered me. The order books didn't look chaotic, they looked prepared. Sell pressure was aggressive as but controlled. Buy walls appeared at precise intervals, absorbing panic. Not retail buy walls, institutional size, clean execution, no emotion, someone knew. Because while retail investors were scrambling to exit, certain wallets were quietly accumulating. And that's when I realized something uncomfortable. The delisting wasn't the event, it was the cover. What really happened wasn't panic, it was positioning. And the deeper I dug into the wallets, the timing, and the regulatory whispers behind the scenes, the clearer it became this wasn't XRP's collapse, it was a transfer of ownership. I remember the exact wording of the exchange notice. Due to regulatory uncertainty, that phrase again. The same language we've seen echoed since the early days of the U.S. Securities and Exchange Commission case against Ripple. But this time, the timing was different. There had been no new court ruling, no emergency injunction, no breaking regulatory shift, just silence and then suspension. I checked the timestamp. It dropped during low liquidity hours. That matters because when liquidity is thin, volatility is amplified. You don't need massive capital to create dramatic price impact. You just need precision. Within minutes, XRP plunged, social feeds filled with screenshots of portfolios down 30%, 40%, 50%. But here's what didn't happen. There was no coordinated response from major institutions publicly holding XRP exposure, no immediate liquidations from known custodial addresses. Instead, the sell pressure concentrated on retail-heavy exchanges. I started tracking the flows. Large transfers weren't leaving the ecosystem, they were shifting internally. From weak hands to cold storage, that's not panic, that's reallocation. And the exchange's statement, it read like legal insulation, not emergency action, which made me ask the question no one else was asking, who benefited from the timing? At 3:12 a.m., I saw it, a transfer, 8 figures worth of XRP, moving off an exchange wallet into a newly activated address. No history, no prior transactions, just clean reception of size. That wallet didn't flinch during the crash, it absorbed. I traced the pattern. Every spike down into fear was met with structured accumulation, not random buys. Algorithmic entries layered across price levels. Retail was dumping emotionally. This wallet was executing strategically. When markets truly collapse, whales protect capital first. They reduce exposure. But this behavior was different. This was someone increasing exposure during maximum uncertainty. And here's what made it stranger. The funding source appeared indirectly linked to a custodial service used by institutional desks, not proof, but correlation, the kind of correlation that doesn't show up in headlines. While influencers were screaming XRP is dead, the blockchain told a different story. Ownership concentration was rising, which means something critical. If XRP was truly doomed, smart money wouldn't be accumulating into legal uncertainty unless they believed the uncertainty was temporary and profitable. The second leg down didn't feel organic. It felt engineered. After the initial crash stabilized, price began to recover slightly, just enough to create hope. Then, out of nowhere, a coordinated sell wall hit multiple exchanges simultaneously. Same timing, similar volume, mirrored pressure. That's not coincidence, that's synchronization. Retail traders saw confirmation of fear and capitulated. I watched liquidations spike again. But here's the detail most people missed. The second dump didn't create new lows with conviction. Volume was high, but follow-through was weak. It looked like an attempt to flush remaining leverage. A bear trap inside a delisting narrative, and once leverage cleared, the selling slowed, which means the objective may not have been destruction, it may have been cleansing. Headlines framed it as regulatory doom, but I went back to the court docket involving the U.S. Securities and Exchange Commission and Ripple. No new filings, no emergency motions, nothing that justified immediate suspension beyond risk management. Exchanges manage risk, but they also manage exposure. If an exchange anticipates clarity, positive clarity, is coming soon, delisting before that moment accomplishes two things: limits liability, suppresses price before repricing, and if large players expect a regulatory pivot, they would want maximum accumulation before narrative shifts. The media focused on fear. They didn't follow the money, and the money wasn't leaving. It was settling. I read the comments. I'm done. They tricked us again. Should have sold months ago. This is the emotional phase institutions wait for. Capitulation isn't loud optimism, it's exhausted surrender, and surrender creates liquidity. People who sold everything for XRP didn't just lose capital, they lost conviction, which is far more valuable to smart money, because once conviction breaks, supply floods the market. And when supply floods the market into prepared buy walls, ownership transfers quietly. I could see it in the order books, smaller wallets disappearing, larger ones expanding. The narrative shifted from temporary setback to structural failure. That shift matters because when narrative reaches maximum negativity, price often reaches maximum opportunity. No major fund publicly condemned XRP, no official statements distancing exposure, silence. In markets, silence can be louder than criticism. If institutions believed XRP was permanently impaired, we would see exits. Instead, we saw patience. I noticed derivatives funding rates normalize quickly after the crash. That suggests professional desks weren't leaning heavily short. They weren't betting on collapse. They were neutral, waiting. That's not how you behave around a dying asset. That's how you behave around temporary dislocation. By the third day, volatility compressed. The violent candles gave way to narrow ranges. That's when the real repositioning happens. Fear subsides, volume drops, attention fades, perfect conditions for accumulation. The exchange delisting removed short-term traders, speculators moved on. What remained? Long-term believers and silent capital. The float tightened, which means when demand returns, supply shock becomes possible. Delistings feel like endings, but structurally they reduce circulating liquidity, and reduced liquidity amplifies future moves. Markets don't turn on good news. They turn when bad news stops getting worse. All it takes now is one regulatory clarification, one partnership confirmation, one relisting announcement, and the same crowd that panic sold will chase, because humans anchor to previous highs, and XRP has history. If sentiment shifts, re-entry pressure could be violent. The delisting created despair. Despair creates asymmetry. Here's what I've learned watching this unfold. Events are rarely what they appear to be. The delisting wasn't just about regulation. It was about redistribution. Retail sold certainty. Institutions bought optionality. That doesn't guarantee XRP's success. It guarantees one thing: ownership has changed. And when ownership concentrates in patient hands, volatility eventually returns in the opposite direction. If you only react to headlines, you'll always trade the second move. If you watch liquidity, wallet flows, and silence, you might catch the first. The market doesn't reward emotion. It rewards positioning before clarity. And clarity always comes after price.